Hi, I'm Denise Chisholm, Director of Quantitative Market Strategy at Fidelity Investments. And today I'll be talking about some of the more important trends I'm seeing in the markets and what history has to tell us about the outlook for the broad market and individual sectors. The biggest story in the first quarter was the U.S. and Israel's military conflict with Iran. Attacks have damaged energy infrastructure in the Middle East and disrupted shipments of oil through the Straits of Hormuz. Energy prices have surged and market volatility has risen. Stock markets have declined, reflecting investors' concerns about the potential effects rising energy prices could have on U.S. and global economies. That said, history suggests the conflict's longer-term impact on the markets might not be as negative as many investors fear. Looking back at 11 major geopolitical shocks, from Pearl Harbor to Russia's invasion of Ukraine, the S&P 500 posted positive returns a year later in 8 cases, with average gain of about 8%. Investors are especially concerned that higher oil prices could boost inflation, forcing the Federal Reserve to raise interest rates. But that's not always how oil price spikes have played out. Big 6- and 12-month gains in oil prices have corresponded with higher core CPI only about 50 and 60% of the time, respectively. Likewise, big 6- and 12-month gains in oil prices have not meaningfully increased the likelihood of rate hikes. Meanwhile, tech valuations have started to look more attractive. The sector sold off in the first quarter as investors worried AI could disrupt traditional software business models. Tech's relative valuation fell to its lowest level since 2020, based on forward price-to-earnings ratios, dropping to the second quintile of its historical range. Now, previously, tech has outperformed the market in 69% of the 12-month periods after second quintile relative valuations. I think home building stocks are interesting too. Housing turnover since 2023 has languished near 4-decade lows, and some investors worry that rising interest rates or rising unemployment could undermine the recovery. Historically, home sales have tended to improve after bottom quartile and bottom decile turnover, even when rates or unemployment rose. Home builder stocks have outperformed the market by wide margins on average in the 12-month periods following with low housing turnover. For more information about our views on current market trends in sector investing, please read our complete quarterly sector and investment research update for the quarter at fidelity.com/QSIRU. Thank you.